Good morning, ladies and gentlemen. If we could please ask you to make your way towards your seats. Please make your way towards your seats in the main venue. Thank you.
This is Africa, abundant, alive, with energy, with possibility.
We know who we are, what we have.
The richness of our soil, the power of our people.
This is Africa. This is our time.
Our economies are thriving. Our continent is rising.
Africa holds the key to renewable energy, our never-ending sunshine, our coursing rivers, our mighty wind. Africa has what it takes to lead the global energy transition. This is Africa, and the opportunity is now to be part of what's happening on this extraordinarily rich continent right now.
To invest in a continent whose wealth lies untapped. Invest in technology in a digital economy worth $180 billion.
Invest in infrastructure, in roads, in rail, in energy projects that unlock resources and riches. In manufacturing, as Africa's industrial output grows at double the global average.
In tourism, Africa is home to some of the world's most sought-after destinations. From agriculture to real estate, renewable energy to logistics. Investing in Africa is easier than ever, more accessible than ever, makes more sense than ever.
1.4 billion Africans united as one powerful economic bloc, with South Africa at its heart.
Offering you one continent,
one market,
and a million opportunities.
Ladies and gentlemen, welcome your host for today, Nancy Kachingira.
Your Excellencies, Honorable Ministers, Central Bank Governors, ladies and gentlemen, good morning and welcome to the Standard Bank African Markets Conference 2025. It's wonderful to see you all here today. My name is Nancy Kachingira from BBC News, and it's my great privilege to be your guide through the program over the next couple of days. Now, in my long career reporting in Africa, I have realized something important. The most compelling stories are not to be found in broad generalizations. They're to be found in the specific nuanced realities on the ground. And this is very true when it comes to the narrative around risk and opportunity in Africa. Think about an analyst looking at African risk. They might miss the tech evolution that's happening in so many cities around the continent. The investor only focused on emerging market volatility. They might overlook how national pension funds are transforming infrastructure financing. Or the economist, broadly tracking developing economies, they may not see how creative industries in Africa are redefining global entertainment. That's why, over these next 2 days, we want to talk about the specifics. We'll tackle how to demystify Africa's perceived risk premium. We'll showcase bankable opportunities in energy and infrastructure. And we'll explore strategies to attract greater foreign direct investment. So what we'll be doing is looking beyond the headlines and engaging with Africa's markets as they truly are: diverse, dynamic, and full of untapped potential. So thank you for being here today. Just a few practical matters as we start. We will have scheduled breaks during our program today, where we'll serve some light refreshments that will be outside and to my left. Those breaks are also an opportunity for you to continue the conversations we'll be having here, so I hope you'll take advantage of that. Wi-Fi is available. The details will be on the screen periodically. And I'll extend a warm welcome at this point to those who are joining us on our live stream. Remember, if you want to share some insights on social media, you can use the hashtag #StandardBankAfricanMarkets, just so we can find and engage with your comments. So with those practical details covered, it's my pleasure to introduce our first speaker to establish our economic coordinates for the day. Someone whose career trajectory, interestingly, mirrors the very transformation we seek across African markets. Ladies and gentlemen, Luvuyo Masinda, Chief Executive of Corporate and Investment Banking at Standard Bank, has navigated the complex terrain of African finance, not from a distance, but from within its most challenging landscapes. You could say he's been at the coalface. His journey through Standard Bank reads like a masterclass in strategic leadership, from steering financial performance as Chief Financial Officer, to building client relationships as head of the coverage team, to mastering risk assessment as Chief Risk Officer, and ultimately serving as Deputy Chief Executive before assuming his current role. Now, what makes Luvuyo particularly well-positioned to begin our program today isn't just his technical expertise, but also his unwavering conviction that capital, when strategically deployed, can unleash Africa's extraordinary economic potential. Throughout his career, he's been more than a banker. He's been an architect of possibility, consistent in demonstrating that informed investment in African markets yields not just returns, but impact. A leader who doesn't just talk about Africa's future, but actually actively shapes it. So ladies and gentlemen, please join me in welcoming Luvuyo Masinda, Chief Executive of Corporate and Investment Banking at Standard Bank Group.
That's the best introduction I've ever received in my life. Your Excellencies, Honorable Ministers and Deputy Ministers, Central Bank Governors and Deputy Governors, esteemed guests, clients, colleagues, ladies and gentlemen. On behalf of the Standard Bank Group, it's my great pleasure to welcome you to this, the African Markets Conference. And what a beautiful backdrop that we're holding at Stellenbosch. One of my colleagues, Guido, yesterday mentioned we previously used to host this conference under a different name out of London for 15 years as the Africa Investor Conference. And for the first time, we felt it, and rather they did, to be honest, compelled to bring this home. And there's no better site than to have it in Stellenbosch. I'm really honored to welcome you, the leading voices in policy formulation and implementation, financial markets, capital markets, and investment, to chart a path for Africa's next phase of growth and economic development. I think as we think about the narrative and the context that Africa finds itself at the moment, we can all agree that it is time to reshape this global perception of Africa. A narrative that is dominated by perceived risk, instability, and conflict. Data suggests a different story, though. And here are some of the key stats that I would like to quote. Africa today accounts for 40% of the global reserves of the critical minerals that are key in the energy transition. The continent leads the world in mobile banking, with sub-Saharan Africa holding nearly 50% of the global mobile money accounts and driving $2.5 billion in transactions on a daily basis. The expansion of fintech solutions led by M-Pesa, as an example, is broadening financial inclusion, particularly among underserviced communities. Africa's population of nearly 1.5 billion is forecasted to reach 2.5 billion by 2050. This is evident in the urban population growth that we've seen of approximately 350 million people in 2014 to nearly 500 million by the end of 2023, representing a 40% growth in just a decade. Of particular interest is its youthful demographic, which represents an untapped market and workforce, ready to drive the economic growth of each of our markets. Lastly, the Africa Continental Free Trade Area holds the promise of creating the largest free trade area in the world, boosting intra-Africa trade and promoting economic integration. So why are we here today? This conference aims to find solutions that are necessary for Africa's growth and to tackle issues in relation to Africa's debt and credit outlook. So how do we meet our financing needs without compromising our own growth and the sovereignty of each of our countries? Closing the infrastructure gap. What are some of the innovative funding models that can unlock Africa's full potential? The issue around energy stability and transition. How can we secure Africa's energy while embracing sustainability? Navigating this real difficult macroeconomic volatility. How does Africa respond cohesively to the big shifts in the global geopolitics and to be still able to deliver really strong growth? What are some of the structural and policy reforms that are necessary that will position Africa as a winning investment destination and attract the foreign direct investment? And lastly, what are some of these challenges that we're presently facing that require decisive and actionable solutions? The continent's economic fundamentals remain strong. According to the African Development Bank, GDP growth is still forecasted to reach 4% in 2025 and nearly 4.5% by 2026, outpacing many other emerging markets. Africa also remains the world's second fastest growing region after Asia, with 12 of the 20 fastest growing economies projected to be in the continent. And whilst Africa's prospects and economic resilience are undeniable, achieving these growth rates requires resolute policy actions. Increased coordination between monetary and fiscal policies is required to manage issues such as inflation while promoting economic development. Furthermore, Africa's external debt now surpasses $1.5 trillion. And that is a number that often makes headlines, and rightly so. But I think one of the things of more concern to myself and the team at Standard Bank is the additional cost of the debt burden, which we believe stems from the inflated risk assessment, resulting in higher grades from rating agencies and increased market pricing. A 2023 study reported by the Africa Practice reveals that the continent could be losing up to $4.2 billion annually in interest payments on its loans, primarily of this inflated risk assessment. At Standard Bank, we're working with governments, multilaterals, and investors to design what we believe are financing solutions that will drive the long-term stability. We believe that Africa risk premium can be mitigated through improved investor relations, adherence to orthodox fiscal and monetary policies, and efficient use of borrowed funds. Africa's success should be predicated on investment, innovation, and economic development, rather than constrained by debt levels. And as we think about those, we've identified two key, sectors that provide the biggest opportunity for this growth. I think the first one is infrastructure, which we believe provides Africa a real competitive edge in terms of attracting capital. The continent has made significant progress in infrastructure development in recent years, with many countries committing billions of dollars to improve transportation, energy, water, and digital networks. Notably, recently, the South African Minister of Finance committed over R1 trillion, or over $1 billion over the next 3 years in infrastructure investment during his budget speech. This infrastructure boom is crucial for promoting economic growth, creating jobs, and reducing poverty. With the right reforms and investment, Africa can build modern infrastructure needed to boost trade and transform the continent's economic prospects. Current investment still falls short of demand. The funding gap for infrastructure is between $130 billion and $270 annually. It is pleasing, though, however, that the government, DFIs, and the private sector are stepping in, and we are seeing real progress, including the Lobito corridor across Angola, DRC, and Zambia that is set to maximize and promote trade, investment, and economic integration between these three nations. The Tanzania-Burundi Standard Gauge Railway, which will transform East Africa's connectivity while boosting trade and mineral resources. At Standard Bank, during 2024 alone, we mobilized nearly 20 billion rands of our own capital into infrastructure projects across the continent. But this is not enough. Public-private partnerships, blended finance, and innovative risk-sharing models are essential to bridge this gap. We believe that the infrastructure development should be prioritized to enable investment. And in this regard, we urge policymakers to implement policies designed to drive investment in integrated infrastructure. This will support economic diversification and improve the business environment and reduce the cost of doing business across the continent. The second relates to the energy and Africa's global momentum, and moment, in fact. Infrastructural development is not possible without energy. To power not only these infrastructure projects, but to also our growth industries, schools, hospitals, and homes. Across the region, demand for energy is growing, but modern energy use per capita remains among the lowest in the world, despite ample energy resources across the continent. Africa accounts for just 6% of the global energy use and less than 3% of the global energy-related carbon dioxide emissions. More than 600 million people on the continent currently live without access to electricity, and nearly 1 billion do not have access to clean cooking supplies. A step change is required in financing, including from the international community and private sector. To achieve Africa's development goals, energy access, and climate objectives, energy spending on the continent needs to more than double by 2030, with more than 2/3 going to clean energy. Africa has some of the world's greatest renewable energy sources, yet it receives less than 5% of the global renewable investment. We believe that this must change. We're seeing positive momentum in this sector as well. And some of the examples, the Sanankoroba solar power plant in Mali, 200 megawatts, and will add 10% to Mali's electricity supply. Green hydrogen investments in Namibia and South Africa are putting Africa on the map as a future clean energy hub. Energy can be Africa's global moment. However, more is needed. It is important that our energy transition is pragmatic. Energy security must come first. Natural gas, we believe, will remain a critical part of our energy mix. The transition must be Africa-led, Africa-financed, and Africa-executed. In the past year, as a group, Standard Bank mobilized 75 billion rand in sustainable finance, reflecting our own commitment to energy transition. And in closing, ladies and gentlemen, whilst we acknowledge the realities of the inflationary pressures, selective global capital, and a shifting trade landscape, we once again have the opportunity to help shepherd Africa's growth story of resilience, opportunity, and transformation. Over the next 2 days, we will hear from the champions of this future, leaders, investors, and policymakers. We hope that those in attendance here today will take the time to meet each other, learn from one another, and find common purpose, ushering in new paths for the continent and its people. At Standard Bank, we stand ready to finance, to partner, to facilitate, and to mobilize capital, because we believe unequivocally that Africa is our home with driver growth. Thank you, ladies and gentlemen, and I hope you enjoy the next 2 days.
Thank you very much, Luvuyo, for setting the stage so perfectly. I think you've really highlighted why it's important to look at the specifics. And actually, one of the examples you gave about the punitive risk premiums on the continent reminded me of an observation I made in 2017. Some of you might remember when both Italy and Kenya signed deals with China for the Belt and Road Initiative. I was struck by how both were reported in the news. When Italy was reported on, this was a nation making its own decision and taking a calculated risk. In Kenya's case, however, it was framed as, oh dear, do they know what they're doing? And that was the overall tone of some of the messaging. And when we ask, what's the continent's debt to GDP ratio? And we see that it hovers just around 64%, and yet many bigger, larger, richer economies are over 100%. We have to ask why this framing exists. And as Luvuyo pointed out, it's often in the nuance, in the expense of the debt that Africa receives because of some of these narratives. Thank you very much, Luvuyo, for setting the stage for us. And one thing we're going to do now is get a view from the room. As someone much wiser than me once said, perspective is important because we see things as we are, not necessarily as they are. But what we're going to do now is have an interactive segment, which we're calling our view from the room, where we'll take the pulse of the gathering here today. This segment will be led by Shola Adebesan, who is Head of Client Africa Regions Global Markets, alongside Alex Davidson, Head of Client South Africa for Global Markets. Together, they will guide us through a real-time assessment of perspectives represented in this room, setting the foundation for the rest of our discussions throughout the conference. So please join me in welcoming Shola and Alex.
Thank you, Luvuyo. Thank you, Nancy. I think that that idea about perspective is very, very apt as we go into this session. So if anybody's taken a moment really just to look through the most recent set of FOMC statements that were released on Wednesday after the recent Fed meeting, or if you haven't read them and you've just taken an opportunity to scan some of the most recent FT articles that have come out in the last couple of weeks, I hope it's become very clear to everybody that the change in global power is starting to really drive a massive wedge through the decision-making of some of our largest and most powerful central banks. If we just have a look at some of the monetary policy that's taken place, you've got the Fed that have come out again last week and kept rates on hold. Whereas if you have a look at both the ECB, well not both, the ECB, the BOE, and the Central Bank of Canada, they've already cut interest rates this year, and they've left the door wide open for further interest rate cuts. If you then move to fiscal policy, I mean, I don't have to say too much about the Doge in the US that's been brought in. They initially spoke about reducing federal spending by up to $2 trillion. They've scaled that back to $1 trillion now. But if you contrast that against what's going on in Europe at the moment, where there possibly soon could be a bill that's passed in Europe where Europe's going to go on a €1 trillion spending spree. And so really, when you have a look at this massive dislocation that's starting to take place throughout the world, I mean, prior to this, the world was really moving in lockstep with the Fed. But at the moment, there's massive uncertainty that started in the world. And uncertainty creates volatility. And volatility makes it very difficult for all of us here to value assets. And so it's very much with that in mind that we thought it would be a very good idea to start the day with some perspective and to kick things off with a quick-fire, rapid session where we've chosen 5 interesting asset classes, and we're going to work with you, the audience, together with some experts from Standard Bank, and we're going to get your views, our views, on where we think these assets are going to finish this calendar year on the 31st of December.
I think if there's anything that stuck out in everything that has been said so far, is that the world and the financial markets are going through an unprecedented level of uncertainty. In fact, my favorite phrase for 2025 is, the world is in a period of certain uncertainty. And for that reason, forecasting of our financial markets has become extremely important. So today, you all are going to be the forecasters. If you get it right, I was part of it. If you don't, I had no clue. So we're going to use Mentimeter. If you could all please bring out your phones, scan the barcode. And as you scan the barcode, the Mentimeter will come up. And we're going to start. There's some on the ground, there's some up there. And we're going to start with a simple one. The dollar rand, obviously the largest economy in...
Am I in the way? Sorry.
So we're going to start with dollar rand, the largest economy. South Africa has the largest economy on the continent. So we said, let's start with an easy one. To my Nigerian colleagues, I'm sorry to say it, yes, they do have the largest economy on the continent. So you have 3 options, 3 forecasts. Above 19, below 1750, between 1750 and 19.
Oh, Shola, I think we've been too kind with how broad our range was.
Yeah.
Hey?
I think, yeah, maybe we should have made it even narrower. A bit. Let's start with an easy one.
Yeah.
And I can see everybody is sitting on the fence.
All right. Well, so that looks like that's going to settle somewhere between 60% of the audience feel like between 1750 and 19.
Yeah.
Let's lock it in there.
Cool. Alex, are there any prices for...
We'll work on it afterwards, right? Should we leave it there, Shola?
Yes.
Let's leave it there, guys. We've got a Standard Bank expert who's recorded a video, and they're going to give us their view.
Resilient, quite stable over the past 12 months. I think you're going to see a similar kind of trend playing out over the next 12. The reason for that is that I think the dollar has a structurally weaker undertone because of what's happening to the US economy and the fact that US authorities would like to see the dollar weaker. But having said that, there's going to be quite a lot of movement between now and the end of the year. The uncertainty that we see currently could see the rand pop up above, say, the 18, 19 level, but that pop would probably be temporary. And at the end of the year, we would have had time for the rand to normalize to the levels that we're at the moment.
Okay, so that's interesting. So 60% of the audience basically felt that we'd stay in the range, 1750 to 19, and our expert, Mamaketi, feels that that's going to be the same case. So it seems like there's broad consensus that that's going to be the outcome. Shola, we're going to move to something a little closer to your heart here, oil.
Oh, yes.
So we've got Brent crude currently trading at $72 odd, and then we've given you 3 ranges here, above $80 a barrel, below $60 a barrel, and then somewhere between $60 and $80 a barrel. Where do you think oil will finish the year?
Okay. I do believe my friends from Nigeria and Angola, I know where your mind is.
They're in the 36%.
And for the oil importing countries, I know where you're thinking. And from this chart, I think there are more oil importing countries here. And it's very interesting because this one I was very interested to see the answer because the views you get out there are so varied around oil. On one hand, you have people talking about the uncertainty and possibility of conflict across the world. But then, on the other hand, we have conversations around the fact that the US wants to become more oil dependent, which means more supply to the market. Then there's the Chinese who are also expected to import more oil or use more oil this year. So it will be very interesting to see where this ends. And again, it seems like we're all in between. The period of certain uncertainty.
Right, so we've got 60% there, within the $60 to $80 range. Let's have a look at what the expert has to say.
So I'm bearish oil. I think on a technical basis, oil has been in a downward trend, forming a series of lower lows and lower highs, at least dating back since September of 23. And in fact, I think last year, September, it formed a death cross on the monthly chart, which is a very bearish signal. If you go to the fundamentals, on the growth side, globally, there's a lot of concerns. Obviously, Trump's on-again, off-again tariffs should negatively impact growth, which should mean that there should be lower demand for oil. And then on the supply side, OPEC Plus has committed to increasing production. They're going to want to reverse that production cut they had back in November of 23, which was about 2.2 million barrels a day. I think the estimate is that we'll have about a 0.6% surplus in supply over the next 18 months, which should add downward pressure to Brent. My expectation is about 10% from here, so looking at around $62 to $64 a barrel by the end of the year.
So our expert was just on the lower band of our band, shall I?
You know what this reminds me? It reminds me of, you know when you're in school and the teacher asks everybody a question and says, just write it on a piece of paper and then reveals the answer and everybody starts to erase. That was my number.
What are we moving on to? The US 10-year Treasury now.
Yeah.
I think this is going to be a very interesting one.
Yeah. I think we all know why we put that there, because we all know that the ripple effect of the US economy is very important to us here in Africa. While, when their interest rates are high, it means less investment here, and when it's low, it means more investment to the continent. So I personally want them to reduce interest rates.
Someone a little closer and a bit more balanced.
It's a reflection of how Americans feel right now. Wow.
That's very interesting to see, eh? A much more split view on where things are going to finish. I wasn't expecting such a large percentage above 4.5%.
Yeah.
Clearly, some inflation concerns. All right, let's move to our experts again.
So we're pretty constructive on US bonds. We think yields probably head quite a bit lower in the quarters to come. Unfortunately, as this introduces credit issues, we think that the response will be a monetary response and a fiscal response. And past the point, that'll mean that yields back up again. So I think the only real logical sort of answer out of the three to me right now would actually be to be in the range 350 to 450.
That's a good trader for you. He's completely hedged himself.
I had a bit of, that was what I said.
But maybe the first one where we've had the experts and the audience, not materially, but slightly different. It's the audience with 42% above 4.5%.
Yeah.
The next two are going to be interesting, Shola. These are our slight curveballs to the audience. We'll start off with gold. We've given you gold, 3 categories there, above 3.2, below 2.7. And then, Shola, again, we were too generous on our ranges.
Well, I think bearing in mind that above 3,200, we are asking for all-time highs, whether we're going to see that. clearly. I think the interesting thing about gold is that it's one of those few asset classes that are not really affected by interest rates and affected more by uncertainty. So yeah. Another interesting thing, though, around gold is that it's become very, very topical in 2025. I personally have been engaged in at least 5 or 6 conversations with central banks across the continent with regards accumulation of gold or using their gold in a more beneficial way for the continent. So this, I think, in 2025 will be a very, very important price to look at.
And to take the contrarian view here is going to be to short gold, 4%, below 2,700. All right. What have we got here from our expert?
Gold has had a fantastic run over the past year or so. We're up 50% at around $3,000. I think that gold can still rally a little bit more, but definitely not expecting the same performance that we saw the previous year. But gold is still a protective asset. Central banks are still buying gold in order to diversify their geopolitical risk. So I still think you're going to end up the year a little bit higher, but maybe 3,250. Not a similar rally as what we've seen to date.
Excellent. So for all the ladies, this is another good reason to invest more in jewelry. So when people ask you why you buy more jewelry, just say standard bank gold prices, said gold prices are going to go up.
Store of wealth. All right. Right, our final one for today is going to be Bitcoin. Ooh. Yes, exactly. So currently at about $85,000, above 100,000, below 60, or in a range that you can drive a truck through there between $60,000 and $100,000.
Again, 100,000, bear in mind, is close to all-time highs. So do we think that the Bitcoin price is going to continue to go up? And also realize that Bitcoin also is similar to gold, is a store of value. In fact, I call it the young people's store of value.
Yeah, neo-gold.
Yeah. So again, no pressure. This chart might also give an idea of the average age of the people in the room.
You like that, Cole? So what did we had? We had 55% of the audience felt that gold would be above the top end of our threshold.
Yeah.
But here you've got half the audience essentially feeling that Bitcoin will stay relatively range bound.
Yeah.
So that's quite an interesting outcome. All right, let's see what our crypto expert had to say about that.
Bitcoin has 2 main properties. The first one being its store of value, or 21 limited supply, 21 million coins ever being produced. And obviously it's got a technology angle to it as well. So recently we've seen Bitcoin really follow the NASDAQ price quite closely. We probably expect that to continue in the short term as the US manufacture a sell-off in the NASDAQ to get inflation lower. But at the same time, we're seeing a bunch of regions in the world spending more money: Europe, China, Japan, etc. So eventually, I think it leads to Bitcoin actually regaining the store of value gain, and Bitcoin after a year from now probably being in the 100,000 region or maybe even above.
Excellent.
All right, so slightly different to our
I think
audience.
everybody should give themselves a round of applause.
Thanks, everyone. So, that's the end of that session. I hope it's been a good start and given everybody a sense of where everybody's heads are on some of these assets. Shola and I were laughing yesterday when we were having a look at the session, and we felt that that should definitely be considered by the audience as the long and the short of it, and we hope that it's been incredibly helpful. And what we should probably do now is hand over to a real expert in terms of Gulam, who will be able to give us some guidance. Thanks,
Thank
Nancy.
you.
Thanks, everyone.
Very much. Thank you, Shola and Alex. Who agrees with me? They'd do a good TV show, wouldn't they? The Shola and Alex show. I'd watch that. Thank you very much. That was wonderful, getting the perspectives from the room. And what we're going to do now is take those perspectives and put them into some context, to get some broader economic context. For that, I'm pleased to welcome our next speaker, Ghulam Balim, Chief Economist and Head of Research at Standard Bank Group. Now, his exceptional work has not only earned him the top South African Economist Award, but it's also been instrumental in Standard Bank's research capability, being named Best Research House in just 8 of the past 9 years. Well, as a regular participant in global dialogues on politics, macroeconomics, and financial markets, his perspective today will provide some valuable context for the discussions we're going to continue having on the investment landscape in Africa. So, ladies and gentlemen, please welcome Ghulam Balim.
If I had Alex on my right and Shola on my left, we'd look like that Bitcoin graph. 5%, 50%, and 200%. Welcome, everybody, and especially the dignitaries who've traveled to visit with us. I'm here to frame, at least foreground the next session, a panel discussion, and perhaps even maybe the next day and a half's discussions. I've also come with a little bit of theater. I have to say, though, it's not as glamorous as my forebearers. And there's really just 2 installments that I want to deliver. I want to talk a little bit about the global economy. No doubt many of us will have certainly inserted ourselves and understand better, at least the direction of travel, even if we don't have a good sense of the breadth of dispersion that could unfold. And the second bit that I will engage with is with respect to the consequences for sub-Saharan Africa, or at least presenting some framework upon which we can think about how the very changed global environment is going to impact the world. I've entitled my presentation The Big Reset, and certainly it is as substantial as that. Thank you. There can be no doubt that President Trump is upending the world, upending the norms and standards that we've been familiar with for at least 70, even bordering on 80 years. There can be little doubt, too, that he is withdrawing the US's centrality in global multilateralism that has been so significant in maintaining guardrails of society for an equally length of time, bordering on 8 decades. But President Trump is both cause and consequence. Cause to the extent that certainly he is injecting an entirely new policy paradigm, a policy paradigm both internally with respect to the United States and, of course, externally in terms of international affairs. The big reset, who would have thought just a few years ago we would witness war on continental Europe? Who would have thought that we would see transatlantic ties fray as perilously as they've already begun to do? But when I say President Trump is also consequence of trends that have already been in play now for some time, preceding President Trump. I don't have too much time with you, so I'm going to be fairly crisp. But allow me to at least start by just articulating a bit of economic history, particularly since 1945. We can divide the last 70-odd years into perhaps 3 epochs, 3 eras, not necessarily distinct, but sufficiently robust within the contours that I will attempt to articulate. Between 1945 and roughly 1970, we could describe it as an age of prosperity in the developed world. The United States enjoyed an electricity boom, they enjoyed a middle-class boom, and certainly along with that, a baby boom. Productivity growth within that paradigm of time was around 4%. Per capita income growth was not too dissimilar, and certainly economic growth was handsome. But that era of Western market prosperity, and even in Europe with regard to its reconstruction in the aftermath of the World War, was very rudely interrupted in the early 1970s. New actors surfaced, harnessing the resources that lay beneath their soil, otherwise known as oil, and it would unleash an episode of severe stagflation in the United States. Productivity growth in the 1980s fell to around 2%, economic growth plummeted, and the United States encountered a level of dire straits that it was unfamiliar with. We entered in the 1970s and through the 80s a period of contention. The 80s was significant also for Ronald Reagan and Margaret Thatcher. In addition to the contentious period of the 1970s spilling into the 80s, they introduced deregulations. The era of markets would be beckoning on the back of the impetus that they would inject into the economy. Less regulation, less state. But the 70s and 80s perhaps fall into that second epoch, second era, which I've suggested is a period of contention. The early 1990s, the fall of the Berlin Wall, the Maastricht Treaty, the Soviet Union's collapse. The last 30 years, from the early 1990s, let's say, to just prior to the onset of COVID-19, we throw our arms around globalization. We throw our arms around the era of markets. And many of us have been practitioners in this period. So 3 distinct periods. And I think what I'm trying to underscore is that between a 20 and 30-year horizon, we tend to go through structural episodes, beyond just the mere business cycle. But structural episodes, and I suspect we're on the cusp of one such episode. This is not just an incremental reattachment of the global economy to the type of rhythm that we were familiar with in 2019. This is entirely different. Multilateralism shifting from the type of moderate multilateralism that we're familiar with for the last 30 years, where there was some friction, some contention, but it was generally benign, to a period of elevated structural frictions. And already you can imagine, I'm hinting that the prospective years and decades has some level of parallel with the 1970s and even the 1980s. Remember, I mentioned the deregulation of that era and seemingly the push towards deregulation now again. So we've seen this movie before, even if it's not quite the same. In terms of integration, the globalization of the last 30 years in terms of people mobility, capital mobility, and certainly trade, innovation spillovers, seems to have reversed. I'm not too fond of the phrase slowbalization, apart from it being not too eloquent, or the idea that in fact there's going to be the wholesale retreat from integration. It's worthwhile considering that global trade growth this year will still grow at around 3, maybe 4%. It's worth also considering that 7 of the world's 10 fastest growing trade corridors exclude the United States. That means that trade connectivity is expanding, even if the bifurcation is the United States and the rest of the world. With Europe even now, who would have thought, being a representative of the global north, embracing the global south. As an adversary, the United States stands in that paradigm. We've argued for a length of time that economic activity is shifting from the west to the east, but it's not that simple. We cling to this notion, but it will not be a straight line. I'll amplify on that in a moment. There's a greater level of intolerance around the world, democratic dispensation increasingly being overtaken by illiberalism, and that illiberalism creating more extremities in terms of the level of discord, polarization in society. The last 30 years, the World Wide Web and the Internet of Things was foundational to providing impetus to global economic growth. And now it's artificial intelligence that is going to provide the next set of S-curves, along with quantum computing. One of the very significant differences is that for the last 30 years, the World Wide Web and the Internet of Stuff was largely free. One just needed hardware, not to belittle accessing hardware as a sometimes barrier to entry. But governments did not seek primacy in technology the way they do now, and the microchip wars and the attempt by the United States to preclude, say, China from being able to get access to more sophisticated technology is significant. I'll amplify on that too. Lastly, even though this list is not certainly exhaustive, seem to have shifted from the last couple of years of woke thinking to the idea that if you go woke, you'll go broke. And certainly, it's become the nemesis of the President Trump administration. Like I said a moment ago, this list is not exhaustive, but it does speak, and I hope articulate the notion that these are structural changes. It's not simply incremental movement, and structural changes across broad lines of society, and that even mingle to amplify the extent of change. But as I also said a moment ago, this has been brewing for some time. This exhibit is just to give you a sense of certainly the trade uncertainty and more broader policy uncertainty. So the orange line has been escalating for some time. The blue line speaks to trade uncertainty, and particularly President Trump's first term. In fact, it was in his second year, during his first term, when he began to more vigorously assail China. And of course, this time around, it's the rest of the world as well. In addition to this, and for the many reasons that seem to explain why we have this level of geopolitical tension, populist leaders are in fact in abundance across various geographies. Big men is what we may sometimes reference them. And there's many reasons that has given flourish to populism, and hence populist leaders with some level of charisma and charm and riz, garnering society's angst and using it to weaponize their political agendas. A little bit novel, but this exhibit, what I aim to just show is the K economy. The exhibit on the right side, as I said, a little bit novel, showing the price of Ferrari and the price of Dollar General. The idea being that those with high incomes spending discretionary income on luxury items, seeing the revenues of the purveyors of their discretionary items certainly soaring, and certainly incomes or revenues, profits, as well as share price. But Dollar General, a purveyor of basic necessities for price-sensitive consumers, slumping, giving breath to that idea of a K economy. And the exhibit on the right is just simply the stock market, the S&P 500, and working class incomes. And again, the idea that, to speak colloquially, the rich are getting richer, the poor are getting poorer. And so they give impetus for the likes of President Trump to be able to either be selling a constructive path or the snake oil salesman, which time will tell. We think AI is momentous for a variety of reasons, apart from being the most potent technology that humankind has ever embraced. But we think that America's assailing the world, and particularly in due course China, speaks to the connectivity of the parallels between this era in artificial intelligence and what it means in terms of the Industrial Revolution more than 100 years ago. The Industrial Revolution and the takeaways from that are significant to the extent that what it meant was a few nations that were at the frontier of the Industrial Revolution, the United Kingdom, the United States, Japan, and even Russia, frontier nations that led the Industrial Revolution would come to conquer the rest of the world. Most other nations during that era did not even know what was happening. Most other nations would become followers, and in fact the level of command and authority that the frontier nations, those that led and were at the helm of the Industrial Revolution, dominated the world. And in some sense you could argue that the Industrial Revolution spawned a great deal of global inequality. The laggards would follow and would be left behind in terms of income progress. Today, artificial intelligence is the latter-day spinning wheel. It is the latter-day telegram. It is the latter-day steam engine. And nations that have primacy, nations that are at the frontier of artificial intelligence and in due course even quantum computing, will probably be able to have a level of global economic command that surpasses everyone else. And I think Mr. Musk, the Thomas Edison of our time, as some would say, first friend to the President of the United States, gets this. So America, recognizing that it has been, at least now for years, an empire in decline, is attempting to arrest that trend by harnessing these modern-day technologies at the expense of others to be able to generate that level of economic verve. And if we thought that the Industrial Revolution generated a great deal of inequality, it's quite possible. In this winner-takes-all world, and we've generally thought of winner-takes-all sometimes as individuals, sometimes as companies, but winner-takes-all in terms of nation-states also in this competition. I think Elon Musk gets it, and certainly imposing these views on Donald Trump. And some people say, what's the method to the madness? I suspect, and of course we could be wrong, that some of that method relates to this argument that we've just suggested in terms of a latter-day industrial revolution rooted in artificial intelligence and similar other network technologies, and how the nations that dominate these will dominate the globe. America, as I've suggested, a nation in not necessarily decline, but an empire that certainly has lost its hegemonic status. This exhibit just shows you America's contribution to GDP in purchasing power parity terms. Very useful, particularly when judging consumption patterns. And of course, the ascendancy of China and other Asian nations, in fact, is well known. But it's also a bit of a simplification. If we instead look at this particular exhibit, or at least idea, through the lens of current prices, and forgive this slight technicality, current prices, and this is useful for at least judging an economy's verve and dynamism through the production end. In this case, America seems to have not been necessarily stalling. Hence my suggestion that shift from west to east in terms of global economic primacy is not a straight line. America, in fact, has been fairly robust in recent years, with some level of ebb in China. Now, part of this relates quite simply that the United States, if we look at the level of output over the last 5 years, surpasses everyone else. So America's prevailing level of economic heft, combined with quite spirited growth rate for such a large economy, has meant that its contribution to economic output remains fairly substantial, giving some idea to the level of US exceptionalism. But that exceptionalism is also rooted in the very dynamic level of productivity that the United States economy is able to exude, near 2% annual productivity growth since the end of COVID-19, and superior to the productivity growth prior to the COVID-19 episode. If you look at Europe and the United Kingdom, this exhibit perhaps underscores the malaise that those two particular regions have experienced for a length of time. Quite simply, productivity growth has been pedestrian, fractional. You cannot really have a dynamic economy if you're unproductive. It is the backdrop of the microeconomic structure. And if I didn't cement the point of the US's exceptionalism, its dynamism, its entrepreneurial flair, its high skill base, and especially its deep capital markets, and especially the manner in which it feeds venture capital and risk-taking. This exhibit just gives you a bunch of firms by market capitalization that have spawned in recent decades, and not through organic growth, not through merger and acquisition, but instead through organic promise. And compared to Europe, and trust me, we have not scaled this down and scaled that up. It is a common scale. It speaks to the level of malaise and the lack of entrepreneurial dynamism and perhaps deregulatory stifleness that has embraced the European economy. The point being is America is still an incredible market, one to be respected, regarded, and certainly not to be dismissed, but certainly engaged. Very quickly then I want to do is just give you some sense of how we think about global economic growth and growth in various regions over the ensuing year. I mean, it is clear that there's going to be downside risks. This exhibit just gives you our earlier expectations of growth over the ensuing year, in other words, our base expectations, but then adjusted for downside risks. At the minimum, if we take Canada, 2.4% growth this year, with a minimum should the trade wars not be as inflamed as it could be, delivering a 0.7 percentage point subtraction from that base. However, should it become so much more confrontation with little concessions being drained out of Canada by the United States, it's quite plausible that the Chinese economic growth this year could fall by 2.5 percentage points, in fact, delivering then a recessionary condition. So the point of this is there's downside risks, and at this stage, speaking to the level of uncertainty with a breadth of forecast risk. And how does then that play into the Sub-Saharan Africa network? I'm going to describe Sub-Saharan Africa through its external relations. In other words, trade and financial flows. And financial flows, particularly through investment inflows coming to the continent, diaspora money, official development assistance, aid, and of course loans to the continent, the Eurobond market, bilateral loans, as well as multilateral endeavors. So quite a bit. I never quite enjoy talking about trade too much because it's just so hard to convey the multiple dimensions of trade. There's exports, there's imports, there's multiple geographies, and then there is the various goods and services and trying to articulate what it does. So it's complex and it's probably the dullest part of any presentation. But in this fragmented world, how do we think about Sub-Saharan Africa and what are its risks and therefore what are the opportunities to perhaps hedge or even harness the current situation in terms of providing counterweight? Now this exhibit shows you the share of trade as well as the multiple areas of financial flows into the continent as a share of GDP. Per capita income has risen in Sub-Saharan Africa for several decades now, and that's to be cheered. Trade, external trade, has been foundational to that advance, in addition to other areas. Trade now is around 50% of GDP for the region, for Sub-Saharan Africa. Financial flows are less, meaningful, but much less. It's less than 10% of GDP of the particular region. So all of these things matter, but clearly what leaps out at you is trade is a very significant underpin to African affairs, to its external relationships, and then, as I've suggested, a contributor to growth. If we look at foreign direct investment and our external relations or geographies where these are sourced from, it is still primarily a developed market dynamic. In other words, very significant source of funds in terms of foreign direct investment coming from the combination of the United States, Europe, and the United Kingdom. The new partners, let's call them as such, Asia, less instrumental in foreign direct investment funding coming into the continent. However, that mosaic changes very, very quickly when we look at trade. I would argue tectonic shifts in just 3 decades, unsurpassed, unprecedented in terms of such a swift realignment of geographies in such a short period of time. China, broader Asia, in fact the rest of the world, up to half of the continent and Sub-Saharan Africa's international affairs. And when you consider the developed markets only 35 years ago or so accounted for about 75% of Africa's international trading activity. So very meaningful change. Sub-Saharan Africa has been growing a bit more glacial in recent times in terms of intra-regional trade, but still quite substantial and of course much promise. So the FDI mosaic and the trade mosaic quite different in terms of our geographic outreach. And then there is bilateral debt. And here again there's been quite meaningful change. China has emerged as the continent's most significant bilateral lender, far surpassing traditional investors, traditional bilateral lenders. Admittedly, when looked through the lens of multilateral lending, which is not on the exhibit, multilateral lending accounts for between 75 to 80% of all lending to the continent, so IMF money and other similar institutions, but at least in terms of the bilateral lending, from Paris Club to China. And so if we attempt to amalgamate trade, the various shades of foreign direct investment coming into the continent, quite clearly there has been seismic shifts from the type of trade and relationships, financial relationships existed only 20 years ago, as indicated in the extreme left. You can see how the heat map certainly oozes new color. And on the right-hand side, you can see how the amalgamation of those relationships has meant that the continent has different partners. And so in a sense, it's become less tethered to the United States over this time. I'm not suggesting at all that the United States, again, can be dismissed, but certainly the continent finds itself at a stage where those new relationships mean that it provides some natural level, organic level of counterweight. But this protectionism that I alluded to even at the outset of the presentation can be reflected also in this exhibit, where even on the continent, protectionism has risen. When we talk about protectionism, of course, trade barriers are typically higher rates, but they're not just about higher tariffs. They're also about subsidies. And we saw quite an increase in subsidy provision, particularly due to COVID-19, to buffer consumer hardship. But they also relate to licensing and non-tariff barriers. And the essence is that this level of free-for-all and external engagement is being confronted by these barriers. And so with that as a backdrop, how do we think about the continent's shape with regard to its external relations slightly more detailed? I'm going to be a little bit crisp so I can keep within my time frame. With this exhibit, we cast sub-Saharan Africa into that familiar three buckets, meaning the oil economies, then there is the non-oil but still resource-rich economies, and then there are the other or non-resource-rich economies. They're familiar to everybody in the sense of the manner in which the continent is often thought about. And we've got about 23 out of the 45 sub-Saharan African countries that would be considered resource-rich. So 23 resource-rich. And within that bucket of 23, 8 are oil-rich, and the other 15 within that 23 are non-oil but still resource-rich. I've listed some, not all, but some are on your right-hand side of this particular exhibit. What leaps out at you is if you consider this exhibit. Oil exporters have got the dominant share of their external relationships with the United States and the US as the EU and the US as a component, and China, whereas the rest of the world accounts for only 40% of the oil economy's engagement. But if you look at the middle exhibit, in terms of the non-resource intensive economies and the other or non-resource dependent economies, there the rest of the world linkages are far more pronounced. In other words, there's a level of diversification. So what it also suggests is when we think about the impact of external relations and geopolitics on the continent, it could play out quite differently. And maybe that's why sometimes there's a little bit more seduction considered for some of the East African economies relative to West Africa. But it's always never as elegant or as simple as that. Now, if we look quite differently at what the continent trades, some vulnerabilities leap out. Whichever countries, and in total, in terms of the type of product, it's still largely a minerals, resources exporter. Between fuel, crude materials, and that's duplicated, it's essentially dominant. If you look at manufactured goods, the lowest item, it's quite shallow. Speaking to the lack of international linkages of the continent in more value-added products. So that's a vulnerability. The vulnerability, of course, also highlighted by the fact of resource dependence, and in that resource dependence, prone to volatility in prices and also in demand. Luvuyo spoke at the outset of Africa's primacy in some key minerals, rare earth minerals and minerals that is necessary for this renewable energy transition. And here, of course, the region stands out, and some nations particularly. So this exhibit gives you some sense with manganese, South Africa and the rest of the continent, more than half of the global's at least known stock. The DRC is, of course, very significant in cobalt, a little bit of sprinkling in rest of Africa, but the region as a whole, very significant in that respect. Less of a player with regard to copper. But I think what's creeping into you is some level of complexity, diversification, and representativity. I won't deny that in terms of vulnerability to geopolitical shocks, Sub-Saharan Africa stands most vulnerable relative to other regions, in part because of its wide distribution between competing blocks. If we enter into a world where it is going to be aggressively bifurcated, the US versus everywhere else, if some nations on the continent have to make a choice between you're either seated with the United States or you are in lockstep and embrace with the Far East, and particularly China, and you have to forego one, as I'm suggesting, the continent stands most at risk because it is so externalized with regard to key vulnerable areas, a fairly open economy, highly dependent on commodities, volatile commodities, little or shallow, scant interlinkages in global value chains, and high levels of debt and exposure to that debt servicing. If we find ourselves in a worst-case scenario, and this is only a scenario, and my right-hand side, your left-hand side, a worst case and a best case. A worst-case scenario says if the continent has to choose between one particular competing bloc and be completely shut out from another, the potential over 10 years of dent to growth would look like that. In other words, we think the oil exporters would be the least impacted because they could find more aggressive pursuit in the block that they choose to pursue. We note also that the United States has significantly declined in terms of oil export from the continent to that market for the United States' own self-sufficiency, as well as its interlinkages with the Middle East for oil supply. But very quickly, that just gives you some sense of the manner of potential damages. If there is swift movement, realignment, recalibration, and greater intensification with common and shared blocks, it's quite possible that this could turn out positive for the continent, but even then, very quickly, only marginally so. So the bottom line is that unlike the globalization of the last 30 years, we're entering a period of challenge, and the need, while Europe is seemingly being roused from its slumber, I think Africa is also in the crosshairs. Policymakers need to garner the moment, or at least garner the nettle, and introduce some policy responses. Sub-Saharan Africa, as articulated in this exhibit, is probably at risk twice as much as the rest of the world from geo-economic and geopolitical fragmentation. To then just summarize, before we go into the panel discussion then, I think the world needs a new accord, an accord vastly different from that which prevailed over the last 80 years. South Africa hosts the G20 mandate this year, which in its own right is very substantial. But I suggest that in 2025, the mandate of the G20 is far more amplified than South Africa could ever have hoped. One of the positions and points that we're making is that South Africa has a moment in the way in the aftermath of the Second World War, the reconstruction of Europe, the formation subsequent years and decades of the WTO, the United Nations, the World Health Organizations, the increasing guardrails that were imposed on society to kind of calibrate the rules-based world that we're familiar with. There is a moment this year for a South Africa consensus. Maybe in November we'll get a Johannesburg consensus that basically agrees the global North and the global South embrace each other in a manner that they wouldn't have conceived only a few months ago, to the exclusion of the United States, not by choice, but out of sheer necessity. So the G20 this year can serve as a very powerful platform and a bedrock for re-establishing the rules-based order, as fragile as it would be, as contentious as it would be, and certainly it hasn't gotten off to a good start. But it is why the G20 this year and South Africa's role in it is so significant. What I've tried to highlight quite simply is that geo-fragmentation and economic fragmentation poses quite significant risk for sub-Saharan Africa, not as bad as COVID-19, but certainly can be worse than the GFC about 15 years ago. But we make some suggestions at the tail end of this particular exhibit. If there was ever a reason to usher greater impetus with regard to the free trade agreement, greater industrialization on the continent from the more superficial levels of manufacturing industrialization to more heavy industry needs to occur with even greater endeavor. Greater food security, because we import food, we import fertilizer in great quantity, and that's a vulnerability with regard to our external trade was highlighted quite pronounced during the COVID-19 episode. Elevating services trade. Certainly the rule of law needs to be enhanced to invite and enhance the investment climate, and a few other suggestions as well. So there's a fairly lengthy framing episode and insertion. Let me stop there, at least with the first half of my service, and very quickly then go on to the panel discussion. And let me just invite my fellow panelists then to join me on stage as we engage in their panel discussion. So Selvin, Thea, and Dr. Mpugu, please would you come on stage? Welcome. Thank you for joining us. It's really great to have you visit with us, and I'm sure our audience, as well as those online, are relishing the insights that you're going to deliver. Thea, you're closest to me, if I may call you Thea.
Yes, please.
The geopolitical environment, how do you think about it and its consequences for the region?
First of all, thank you very much for this invitation. It feels to me like I'm preaching to the converted already. It has been very enlightening so far. So, repeating the question, please, I didn't hear it clearly.
So, I'm clumsy. I should have just introduced and been a little bit more thorough. S&P Global, African Development Bank Group, Selvin offers yoga classes, is a fine chef, and is also the head of trading at Standard Bank as a night job. Thea, forgive me. With those introductions, just the geopolitical environment and how is S&P Global thinking about its impact, consequences for the region, for Sub-Saharan Africa?
Well, Gulam, I think you really highlighted quite sufficiently during your introduction, and we very much agree. As you mentioned, the US playing a lesser important role to the overall region if you look at trade flows. But I think there's some certain risks on the horizon, and it's got to do with trade, financial flows, and then also the aid story, of course. So on the trade flows, upcoming risks coming up, 2nd of April, President Trump has been quite verbal about the reciprocal tariffs that he's considering, which is not just the sub-Saharan African story, of course, it's a global story, and we still need to understand what it's going to look like, what's the magnitude going to be. And then, of course, South Africans and the rest of the continent really wondering about ALGOA, the African Growth and Opportunity Act, which has to be renewed in September. We do think that the ALGOA will be renewed, but there could be a focus shift, probably more towards critical minerals. And there's, of course, a debate of there's some countries that could be excluded from ALGOA. There's, a lot of questions about that. And then the aid story, I think, also flows into the financial story. Some countries in sub-Saharan Africa are very vulnerable to less aid flows, some more than others, which holds implications for fiscal policy. And then on the financial side, we spoke about higher interest rates for longer in the US, in the European Union, and what that means for emerging market capital flows and capital flows to sub-Saharan Africa. So those are the kind of geopolitical factors we monitor at the moment.
Thea, as you were speaking, I'm reminded, AGOA was birthed as a unilateral engagement. In other words, the United States offered it to Africa without necessarily seeking reciprocity. Africa could export duty-free into the United States, but not necessarily have to prize open their markets for the US. And it's changed to now clearly America seeking reciprocity. Talking about that liberalization, with regard to some markets, notably Ghana, Nigeria, and Ethiopia, I've always been a proponent of the rule of law is foundational to economic advance, and the rule of law perhaps just falls within the broad thrust of reform agenda. Now, these three markets, Ghana, Nigeria, and Ethiopia, have injected a fair degree of reform impetus in recent quarters, and it comes with some pain, high inflation, high interest rates. Have these economies reached the zenith, the peak in terms of that pain point? And do you judge them as improving over the near to medium term and harnessing the benefits of those brave reform decisions?
Absolutely. Yeah, I think those countries like Nigeria, Ghana, Ethiopia really implemented very difficult policies. And I really think this has set the platform for sustainable macroeconomic growth going forward. And I think that's why we're also quite upbeat about sub-Saharan Africa's growth prospects, because of these difficult macroeconomic policies that's been implemented that improve the inflation outlooks, the exchange rate outlook, and the hard currency availability outlook, which has been very problematic for these economies. Including South Africa, if you can see a rebound in South Africa and these large economies like Nigeria, we feel that we can remain positive about the outlook. But as I think the first speaker, highlighted, interest rates alone, hard currency availability alone does not set the road towards sustainable growth. You need those policy reforms that enhance your supply of your economy. South Africa is also a classical example of this. Interest rates alone doesn't bring, lower interest rates alone doesn't build bridges, enhance electricity provision, improve state efficiencies. Those things need to happen to really amplify the growth story in Africa. But I do think these difficult macroeconomic policies really set the scene for sustainable growth going into the next 5 years.
Thea, and not to dominate, and I'm going to come to our fellow panelists in a moment, but the thread of your conversations thus far has spoken to the underlying macro landscape, and ultimately there has got to be some impact on markets. And with respect to the Eurobond market, while 2023 was certainly a drought improvement last year, what do you think is going to transpire with regard to the Eurobond market, with regard to the propensity for lending to the continent? Because that's really where the rubber hits the road in terms of the risk-taking, if conditions are going to improve or not.
Yeah. So, market access has been quite resilient. The first quarter of this year, the clever people tells me, portfolio flows remains resilient, but like you mentioned, there's risk factors on the horizon. And especially for those countries that are experiencing debt distress, with weak economic fundamentals, the Europe and the EU's story is problematic. If you have higher interest rates for longer in the US, you have more difficult access to global financial markets for a lot of frontier markets, which is in sub-Saharan Africa. So it's very likely that you can see maybe again the dominance of multilateral institutions providing financing to sub-Saharan African countries during the course of 2025, a similar trend that what we've seen during the past 2 years.
Okay. Thea, thank you. Dr. Paul Mpuga, if I may also defer now to you. Again, welcome. It's good to have you visit with us. Dr. Mpuga, starting with the opening gambit, the geopolitical environment, and maybe with a particular reference to aid flows, which is significant for many nations with regard to, at the minimum, limiting the hardship and increasing poverty. And I'm mindful that during COVID-19, at least 40 million additional people fell into insecurity, food insecurity. How do you think about the geopolitical environment and the manner in which it's framing the continent's prospects?
Thank you so much, and panelists, thanks for being here, and really appreciate this conference by the Standard Bank. The trend we are in, we are seeing a number of geopolitical movements, and these have not happened only recently, but even last year, Germany, France, the US had a reduction in aid flows to the continent by up to $9 billion. And these are not small monies. Today we are seeing escalation in the geopolitical situation with the aid cuts to the continent, aid cuts to countries dependent on aid from the US. These have large implications, especially on the humanitarian situation. As you've highlighted, food insecurity, health infrastructure, health financing generally. the workers in the health sector, education sector is going to be largely impacted. Climate change financing is going to be impacted. Infrastructure financing, which we've highlighted, is going to be impacted by these aid flows, cuts in aid flows. And more so, the geopolitical tensions also take away attention from Africa. The Russia-Ukraine war, the war in Gaza, they tend to take attention away from Africa. But it is also a moment for Africa to reflect, say, what can Africa do to guard against these tensions? They will continue coming. We have an opportunity. Improve governance, improve investment in infrastructure, improve investment in human capital, so that the impacts of these tensions, the impacts of actions outside will be minimal. We've seen minimal impacts, so for example, on COVID or the financial crisis of 2008, 2009, but this is largely because of Africa's limited integration into the international financial system, international trade. We account for only about 2.6% of global trade. And when issues happen at the global level, our impacts as a continent are limited, but not in a good way. It's because our contribution is weak, and we need to change that narrative. We can change it on the continent. These kinds of discussions, engaging the private sector, engaging policymakers, engaging financing institutions, is very, very critical. Thank you.
I'm mindful, as you were talking about our limited integration, 2.5% of global trade, yet we account for about 16, 17% of humanity. And the Caribbean, Latin America, they account for 6, 7% of global trade. So certainly we're clubbing below our potential, and potential may be rooted in increasing our presence in value chains. But I've been also probably guilty of this in describing the perilousness of the situation. What options does the continent have more full-fledged in terms of countering all of these potential headwinds?
The options are many. We need to do deep self-reflection as a continent, beginning with our leadership. We have many countries in Africa that make small arms, are engaged in tribal conflicts. But we have very few countries that engage in large manufacturing, pharmaceuticals, for example. And if there is something we should learn from the COVID pandemic, is that being prepared, having engagement with the global value chains, helps in situations of emergencies. We have only about 5 countries on the continent that are engaged in large pharmaceutical manufacturing, but pharmaceutical imports into Africa account for about 60–70% of our health care needs, inputs. Now, we need to invest more in infrastructure, like you indicated earlier, and all the discussions. This will help to create the enabling environment for investment, for private sector growth on the continent. We need to invest more in energy, the transformative power of energy in terms of enabling education to go on all the time, enabling private sector investment, processing, healthcare, technology advancement, etc., is unlimited. And this is something we need to take advantage of. We need to promote intra-Africa trade. As we speak now, intra-Africa trade accounts for only about 16% of sub-Saharan Africa's exports and imports combined. When we add on the informal intra-Africa trade, the percentage goes to about 40%. We can do a lot more, eliminating tariff barriers, eliminating non-tariff barriers, making the African Continental Free Trade Area a reality by actually making it work. There's nothing that stops South Africa, for example, exporting vehicles to the rest of East Africa, the rest of Central Africa. I come from Uganda, I live in Kenya. We import most of vehicles used in Uganda or Kenya, even Rwanda, from Japan, many miles further away. We could be importing from South Africa. South Africa is the biggest economy in the region, in Southern Africa. Is growing at only about 0.6, 0.7% last year and this year, the last 2 years. And this doesn't pull the rest of the continent, the rest of the countries in Africa into a higher growth. You mentioned the average growth for the continent at about 4%, but we could do more because we are coming from a low base. As a continent coming from a low base with a GDP of about only $3 trillion, we could grow at 7-8%. And we need to grow at 7-8% in order to double per capita GDP in the next 15 to 20 years. Continuing to grow at 1%, 2% means we'll need 30, 40 years ahead in order for us to double our GDP. There's a lot we can do.
Yeah.
We need to reorganize ourselves, continue these kinds of debates, and really mean a purpose for Africa. Thank you.
Dr. Mpuga, if I may just press you on the African Continental Free Trade Agreement. So much vaunted, a panacea for the continent, 47 or so countries have ratified. But I'm also mindful that when the business cycle abates, when economic hardship envelopes a particular market, the reflex of policymakers is to protect, is to look internally. And we saw this with Brazil, for example, just to use one country in the aftermath of President Lula's first term, internal strife, and suddenly relationships between Brazil and Africa began to recede following that really vibrant increase during President Lula's first term. And there's many examples around the world, so I'll cling to that suggestion. Are you not concerned now that there's sort of these perils, these headwinds, and the idea that growth could be slower, that policymakers assume a defensive posture that is in fact harmful, and the glacial movement with regard to the free trade agreement in fact is locked in as opposed to a greater liberalism that we require? And sorry, lengthy question, just we seem to be, is our ambition a bit too elevated? Should we rather looking for more strengthened regional relationships, a strengthened East Africa, a strengthened Southern Africa, with South Africa, big brother in the south, and West African nations establishing more vibrant corridors? Is that not more practical, more implementable, and still providing a level of celebration for cross-border activity?
True. And the defensive policies, the inward-looking policies, are actually harmful to the countries. The country implementing those policies and the neighboring countries. Before I moved to South Africa, I was in Ethiopia, and in 2021, we did a study on its capital controls. We realized that if Ethiopia could open up its financial sector, gradually remove the capital controls, it could add to its GDP growth up to 2 percentage points per annum for 10 years by opening up. And today they have started opening up. It's a gradual process. The pain you mentioned will continue a little bit, but with a gradual approach, it will open. Now, going to your question, indeed, looking at the regional subgroupings, it makes a strong foundation for the wider Africa continental open trade. Starting with, for example, the East African community, the Southern African Development Cooperation Community, the West African community. Strengthening these blocks and then now bringing the blocks together creates a greater foundation for greater regional integration of the continent. And this is what we need. Thank you.
Dr. Mpuga, thank you. Mr. Kisnasamy, you don't have the luxury of a long-range view. You're a markets practitioner. Volatility sometimes is your friend, and you don't sleep easy overnight. So how do you think about international developments and more immediate, prescient risk mitigation strategies?
Thank you, Ghulam. Look, I mean, I think it's about making sense of the bigger puzzle that you see. And I think it's very important that you keep your eye out and understand what the big reset looks like, as you alluded to earlier, and what those big key structural changes are that the world is experiencing. And just to take a step back, I think that as we emerged from the throes of the pandemic, we understood that the world is going to be driven by scarcity and conflict. We expected the regional dominance to be exerted, as you alluded to, and we expected the financial metrics to drive the pace of that regional fragmentation. And we saw this manifest itself, as you alluded to earlier as well, in inflation, and inflation drove the nationalistic agendas that you experienced at the polls last year. So ultimately, countries have to grow themselves out of their issues, and this reset is looking, it's taking the shape of one of four things, or multiple things happening together. The US has to become more investment and net export driven as opposed to consumer focused, something that's previously relied on. China has to do the diametric opposite in order to succeed. Europe has to become more self-reliant, and Africa has to focus more on productivity as opposed to aid and concession. Those four factors shape the way in which we look at the way foreign direct investment and foreign portfolio investment is flowing. And we isolate a few key themes within that to give ourselves the comfort to navigate the daily volatility. Some of these themes, just as an example, we include US exceptionalism and the stronger dollar. Over time, there will be a need for a weaker dollar, but that's something that drives the way we focus our risk profile. Looking at China, for example, the impulse for lower rates, a bigger stock market effect to create wealth, absent the property market, and the need for the fortress balance sheet to prevent currency devaluations. That's a theme you can rely on. If you look closer to Europe, you can look at the recent developments in Germany, the fiscal and defense packages. Those are big themes that you can invest in both with respect to rates and growth, both in equity and debt. And as you look at what those global powers look to do, you can then cast your eye back to the continent and say, what does it mean for us? Energy, you touched on oil and the oil dependence. If you are able to get your head around the fact that the ultimate impulse for energy is going to be lower, what does this mean for Nigeria, Angola, and your oil-rich countries in terms of currencies, rates, expenditure, and investment? The infrastructure theme, large amounts of cash following specific investment. Those will create large revaluations in rates and different type of cycles attached to that. Commodities, non-oil commodities, the specific opportunities presented to manganese, cobalt, and other resources across DRC, Zambia, and Ghana, which you're seeing a lot of interest in currently. So if you understand where the money is flowing, you can always tilt your risk profile, take your clients to the right opportunities, and be quite confident in what you do, despite the daily inflection points that you see as policy, growth, and inflation changes. And if you ultimately have that North Star, you can create quite a unique mix of risk profiles that ultimately support your clients. And we look quite closely to what Taya and Paul discussed in the policy development space to strengthen those views and to ultimately lead us to opportunity.
Selvin, if I may, so you closed off by highlighting the linkage between policy and markets. And I think I try to also signal that the extent of forecast error in 2025 is amplified. And so there's perhaps a sense of polarity of outcomes. And you're probably thinking through the lens of scenario analysis. What is your thinking in that respect, and what scenario perhaps excites you the most or frightens you the most?
Interesting question. Look, there are a number of scenarios that as you can imagine, if you have growth, inflation, and policy interacting with each other, your scenarios are numerous. But we really look at four key scenarios from a markets perspective. As you saw last year, there was, and this is really the scenario one that we saw, you had what we would call, and sorry to use a trader term here, reflation. Ultimately, what that meant was that you were going to have higher rates, but you're going to have risk assets thrive despite those higher rates. And for Africa, provided the reform was happening in a good enough way, that risk appetite will filter into the likes of West and South and East Africa. And we saw that across Kenya, Nigeria, and South Africa specifically. Fast forward to this year, and the early part of this year, we see the growth scares come in as fiscal capacity eroded and as the sentiment indicators around Trump tariffs started to take effect. As growth came in, scenario 2 emerged. And scenario 2 is really about what does the world look like in a growth strain environment. And there we're seeing largely lower yields, lower appetite for risk markets, but importantly, lower energy prices starting to take shape. And you're seeing some of the fast money exit the likes of Nigeria, not in a material way. People are still confident about the reform, but you're starting to see how a lower growth environment can impact Africa. It's less impactful from a commodity space, and those countries generally remain quite strong. But the real question from here is where to next? And ultimately, that hinges on whether the US policy is going to be a one-off re-rating of the fiscal deficit from 6 to 3%. If that is the case, we see ourselves going back to that same scenario that you saw last year, higher rates, better risk asset prices. If not, your fear could materialize. We think it's a low probability event, but if the bigger than ever policies eat at growth, stagflation becomes a realistic outcome, and the interaction of energy, mineral resources, and more importantly, aid financing across the continent could create quite a unique challenge for us to face at a time when policy objectives are not that clear. So that explains it from a market point of view, and if I quickly may touch from a policy point of view, I think there's a few things we have to look at. Clarity on lending into arrears. How do we make sure that countries who face debt distress can recover from them quickly enough? Ghana still has to launch its bond, and that's an opportunity that we're looking towards. What is the US approach to multilateral institutions, and what's their support to that? And how do we treat some of the preferential status on sovereign credits? These are all issues we have to work through in order to make sure that we're prepared for the next crisis. But most importantly, in the previous crises that we experienced, there was always a solution. We knew it was quantitative easing before quantitative easing was about. We knew that fiscal dominance will exert itself in the previous crisis. Right now, we are not sure. We don't have the bazookas for the fiscal capacity. We have to work through our economies and create better accounting in order to make that happen. And we could face a world where interest rates are capped in the face of higher inflation if stagflation does present itself. And that will create a unique set of challenges that we've never seen before. Low probability, nothing to worry about just yet, but something that does concern me.
Salvin, to quote you, unique set of circumstances. So if the world is changing so fundamentally, are you altering your solution set? In other words, is there financial engineering? Is there novelty that is beginning to emerge in terms of providing our clients with solutions to navigate, to mitigate the current environment? Because I think you're kind of saying we can't also do different things with the same historical tool set.
Yes, definitely. I think you have to cast your eye back, and I've mentioned debt to GDP ratios. As the sovereign limits have been reached within various countries, you have to acknowledge that the role of private markets becomes very important as we navigate ourselves through our growth objectives. From a selfish banking perspective, management of our risk and our exposures to key countries becomes an imperative for us, especially if you consider the size of the infrastructure opportunity being somewhere between 100 to 270 billion rand dollars was, I think, the number that Luvuyo mentioned. So how are we able to transfer and manage and mitigate risk through the banking system with respect to that? And the development of our interbank repo markets across the continent, both as it relates to local economies and its interaction with offshore, is something that we have to focus on. As banks, we have to make sure that we can link our product and create as investment-grade-like products for the international markets to create and to fill those funding gaps that we see. We have to think about co-investment partnerships, both local and offshore, as we bring offshore skills to local skills in order to understand the opportunity and to bring down that cost of debt that Luvuyo alluded to earlier. And ultimately, we have to look at these tools in the pension fund space, the crafting of new or higher asset allocation mandates, specialized mandates in order to cater to the specific opportunities across debt and equity. And it's not really just about the clients, it's about regulators, banks, and clients coming together in order to create these new tools to sustain us to the challenges that we will face. There's one other additional factor, and that's the mindset. And I think the mindset in relation to debt as opposed to equity and other types of investment has to change. And if we really truly appreciate the value that our projects and our resources can offer to the continent, we're going to have to think about different ways about approaching investment that will yield benefits over the long term.
Selvin, thank you. We're almost drawing to a close. We have remaining minutes. I'm going to ask if it's okay, each of you, just your last minute parting shot, piece of advice that you would give to this audience. And I'm not necessarily going to say this to frame your responses, but it's astonishing when you wake up and you think that little South Africa has been parceled with Canada, Mexico, and China in the portfolio of Donald Trump's assailing. It just really alters your mindset of what is possible. But as I've suggested, these things have been trained. So just your final 1 minute remark, Thea, and guidance to the audience.
For me, I think it's really a question. You will see a bucket of investors that consider Sub-Saharan Africa as a risk and those that see it as opportunity. And we are seeing emerging new investment partners from the GCC countries, Saudi Arabia, UAE in particular, India, who's really making use of the opportunity. So it's really about how you look at this continent through what lens. You will either see it as a risk or as an opportunity, and I think that divide is going to become much more clearer with the geopolitical developments we are seeing. But there are countries that are really stepping up, new investment partners who is not missing the opportunity.
I'm mindful of the recent IMF irritation at Abu Dhabi money flowing into Kenya. It was delightful to see. Paul, if I may, final remark.
I see Africa as a continent of large potential in terms of population numbers, in terms of land size. 60% of arable land globally is in Africa. And Africa is also a land of mixed challenges. We lack in skills, we lack in infrastructure, and it is up to us as a continent, with our leadership and the people, to invest in the enablers of growth, to attract investment onto the continent, and to promote growth, to promote trade, to promote real productive capacity in Africa. Thank you.
Selvin, I'm not going to ask you to answer those two questions, because as I looked at you, I just thought slightly differently. Do you see investment opportunities?
Look, we eagerly await Ghana to get back onto its bond issuance profile, because I think that's some unique opportunity to play to, specifically with respect to the commodity theme that we encountered. But maybe one other idea, and that's less continentally related, but it's gold that some of the traders referred to earlier. You know, you referred to the epochs, and way back in the day, gold was used as a tool to pay people in different countries when you went to war, and that's really its genesis for it being the crisis tool. And all you had to see was Russian reserves being frozen for their view to know that the money can't be spent, and it's driving that key central bank that you're seeing, central bank buying that you're seeing as you look to diversify reserves. Whether you're an African country, an offshore country, I think the gold thesis is something that remains intact, and any country linked to basic commodity themes, their rates profile in the next complex looks pretty interesting to us.
Selvin, thank you. Ladies and gentlemen, Ms. Thea Fourie, S&P Global Market Intelligence, Head of Sub-Saharan Africa Economics, Insights, Risks. Dr. Paul Mpuga, Chief Country Economist, African Development Bank Group. Selvin, I fear sometimes, I worry when he opens his jacket, he's going to have a whole lot of items that's for sale.
I do have a few.
And he wouldn't surprise me, but he is our Head of Trading, Global Markets at the Standard Bank Group. Please indulge me in giving them a rousing applause, and thank you.
Gulam and your panel, thank you very much. I've learnt so much in that last session. But I think one of the things that really stays with me from this overview of the macroeconomic context is that this crack in globalization reveals an interesting truth, that economies may be linked, but the world remains divided by narratives, and that now we need a new accord that will unify these stories. I think that was a very strong takeaway from the context setting that we just did with Gulam and his panel. Well, one story we're going to get into now is the story of Angola. As I said, the nuance, the specificity, that's what matters more than the broad generalizations. So for our next session, we are going to hear about Angola. Now, this is one of Africa's most resource-rich economies. We saw in our context setting that that is significant for many African countries. Angola has been undergoing remarkable economic transformation, implementing reforms to diversify beyond oil dependence and create a more sustainable growth model. So this next presentation offers a window into how policy evolution there is creating new pathways both for domestic and international capital to participate in Angola's next chapter of development. Please join me now in welcoming our distinguished speaker for the Vision for Angola session. That's Ms. Cristina Diaz Lorenzo, CEO of the Angolan Debt and Securities Exchange, Bodiva, and member of the advisory board to the President. Please welcome her with me.
Good morning, everyone. Cristina Lorenzo, the Chief CEO of the Angolan Stock Exchange. I'm not part of the advisory board, just to make it clear. On behalf of the Ministry of Finance, I'll be then presenting the Angolan vision for the economic strategy for the past years and for the years forward. So please bear with me for the next 15 minutes. Angola indeed is one of the most oil-dependent economies in the continent. We are struggling, or I would say our principal struggles would be the infrastructure gap, as well as the limited access for foreign direct investors. And to face these challenges, the Angolan government has mainly picked on 4 key pillars, which are the ones I just have here on my left side. The strong growth underpinned by structural reforms and diversification, the fiscal discipline supporting debt consolidation, a proactive monetary policy, as well as a robust external position supported by energy sector progress. To highlight a few of these reforms, over the past 5 years, and especially after the program we had with the IMF, we put in place mainly these reforms. On the fiscal policy side, the Public Finance Sustainability Law, enacted in 2020, established a new policy framework for our financial sector. There was an introduction as well of the VAT system from 2019, which in 2 years' time led it to be the biggest tax revenue for the government in Angola. There was also, it's also going on a program on subsidies reductions, fuel subsidy reductions, initiated in 2023 and will continue to go forward in 2025. This program has been done in a steady pace, exactly to counteract or not to put more pressure in the inflation. It still accounts for around 16% of our GDP, and certainly it's a pressure on our fiscal deficit. On the monetary policy, I can highlight the modernization of the central bank law. A more centralized central bank has liberated the exchange rate system in the past years, as well as changed some of its governance policies. Regarding the financial sector, financial institutions law was enacted in 2021, which helped to bolster the capacity of the banking system. And at the same time, that the capital adequacy ratios have been bolstered in the past years. When it comes to the private sector growth and diversification, the government has put his efforts in the National Development Program from 2023 to 2027, directed to the diversification of the economy. The key drivers or the key objectives focused on the agriculture sector, focused on the strengthening of our human capital, as well as on food security. Food security and the production of fertilizers and so on and so on. At the same time, and there's no way I can speak of private sector growth and diversification without mentioning the Lobito corridor. One of the main projects the government is pushing is the Lobito corridor, the Namib corridor, as well as the energy, also a few of energy sector projects, which of course they count on investment from abroad. They count on the private sector investment from foreign investors, the US being one of them, and there's room for more investment, there's room for more foreign direct investment in the corridor to close the entire supply chain. So we'll look for the numbers of how did this reforms, these structural reforms, have impacted in our macroeconomic fundamentals, our monetary policy, our fiscal policy, and our fiscal position. Angola, for the past years, has been focused on the diversification of the economy. The GDP is now, in 2024, accounting for around $80 billion, which previously was more dependent on the oil GDP, but we can see from here that the actual growth rate of the non-oil GDP is growing faster than the oil and gas GDP as a percentage of the GDP. The GDP rates for 2024 was around 3% and is expected to grow in 2025 to 4.14%. The non-oil GDP continuing to grow faster than the oil GDP. This non-oil GDP growth is mainly supported by a strong tertiary sector, mainly a strong tertiary sector, as well as agriculture and extractive industries. When it comes to our monetary policy, as I previously mentioned, the central bank, the BNA, has become much more independent than it was before, with a more prudent and proactive monetary policy, which resulted in an increased inflation rate, but contained by a rate policy by the central bank. The rate stated at 27% in 2024, but even so, we believe that the increase in the supply of consumer goods, as well as the proactive monetary policy from the central bank, has been contributing to the slowdown of the pace of the inflation. When it comes to our balance of payments, the current account balance is still positive. It remains positive since 2017, at around 8% in 2024, with gross international reserves remaining strong as well at $15.7 billion, which sums up to around 8 months of our imports, of our needs for imports of goods and services. The Angolan fiscal consolidation efforts have reduced vulnerability to oil prices. We do have a much more diverse revenue base, with revenues on taxes from oil services and taxes from non-oil being the two biggest contributors. The fiscal balance It's negative, or it's been negative for the past 2 years, but the primary balance is actually growing or continuing to growing steadily on a positive trend, which is mainly well, thanks to the growth on the revenue from the government. The sustainable debt trajectory. Angola has reached its peak in 2020 with 113%, around 130% of debt to GDP ratio, and brought it down in 2024 to 68, around 68.4%. This is mainly due to a much more proactive implementation of liability management by the Ministry of Finance and the debt prepayments, which were actually supported by a positive trend of the government revenues. From 2025 and beyond, Angola aims to continue to engage with international capital markets. There's plans to actually issue or go to the market to issue a new Eurobond at about $1.5 billion, as well as to capture fundings of about $15 billion on the markets. Our exposure to the debt, to the external debt, is more steady in the last 4 years. Around 47% of our global stock of debt is from foreign investors, both bilateral and multilateral. But the domestic debt is still a significant portion of our debt, which brings us to our domestic capital markets, which around 90% of the total volume traded in our stock market comes from government debt, both on the government bonds market segment, as well from our repurchase agreement segments, which was put in place in 2023. And as we can see, it was the main driver of the growth of the trading volume from 2023 up till this date. In 2024, our trading volume accounted for almost $7 billion, or around $7 billion, as I stated, mostly driven by the government debt activity that is going on. But we do have other markets, we do have other segments in our markets. In the main market, since 2022, we have 4 companies listed as of now, banks, an insurance company, and as well as Bodiva itself. We have the government bonds segment, the corporate bonds segment, which Sonangol has listed a 75 million corporate bond in 2023, and the ETF segment as well. On the OTC market, we have the repos market, which is mainly used by the banks, the bank institutions, by the government itself through the UGD or the debt management unit, as well as we have a segment for small and medium enterprises. In 2023, there was actually an infrastructural change in our market as well, with the exit of banking institutions from the brokerage activity. Until 2023, the banks were the brokers in the market, and from now on, they only have activities in the structuring of IPOs. They have activities as well supporting the brokers in the liquidity activity. Our focus or our main challenges for the next years, both for Bodiva and the Capital Markets Commission, is to then raise up the share of the equity market progress with new listings, both from the private sector as well from the privatization program, which I'll follow in a few minutes, but specifically to guarantee that the foreign investors have access to our markets. the capital entry and exit has now been liberalized by the central bank. There's only a little exception when it comes to investing in government bonds, which requires a pre-authorization from the central bank. But we are working closely with the authorities to make sure there is a smoother problem and that we can attract more foreign investment. As I said, from 2023, we have listed in our stock exchange 4 companies, 2 banks, 1 insurance company, that amount overall for a market capitalization of about $1.5 billion. Other than the listing requirements for the equity market, we're also working closely with the Ministry of Finance to have actually an ESG framework. The country itself has already implemented this framework, looking forward to issue bonds or a sustainable bond in the international markets, but we're also looking forward to have either through a dual listing or in just a local listing of sustainable bonds as well. Regarding the privatization program, we can state, I only have a minute, I need to be quicker. I can actually state that from 2019 to 2022, the government has received $1 billion in the sales of around 89 assets, and for the years forward, from 2023 to 2026, there's expected to be 74 assets to still be privatized. I call on your attention for the list I have here on my left side, specifically for the BFA Bank, Unitel, as well as Standard Bank Angola itself, which are due to be privatized through the stock exchange this year. There's an opportunity for investors, the banks, as well as the brokers and all the ecosystem from the capital markets are working to ensure that there is an easy way in of capital and also an easy way out of capital. With that said, and I believe I managed to keep in my time. Thank you so much.
Thank you very much to Ms. Lourenco. And yes, you kept time beautifully, and I do apologize for the error in your introduction. Thank you for the clarification. A very detailed vision of Angola's economic trajectory there and investment landscape. And I do think it's these country-specific insights that are precisely what make this conference so valuable. This is about moving beyond the general and getting to the nuance. You might be pleased to hear that it's now time to take a quick comfort break. I would like you to come back rather quickly so that we can keep the momentum that we've got going, but refreshments will be served outside, just outside the main area, and when we reconvene, we'll be diving straight into our session on policy and Africa's economic development challenges. So enjoy your break, and we'll see you shortly. Thank you.